Everybody. I'm honored to moderate the first session in the afternoon. This is to release the 2017 Jingshan report on China's financial sector opening up. I think many of you already have the report. I read it briefly. It's an excellent report covering a slew of important issues in China's financial sector, including exchange rate, capital account, and financial institutions reforms. We also have very important panelists for this session. Professor Huang Yiping, who is also the CF40 Academic Committee Chairman and the Dean of National School of Development at Peking University. Professor Huang also worked for Citibank and Barclays, if I remember correctly, as China chief economist. Our second panelist is Tim Adams, the president and CEO of IIF. We know that, everybody knows he served as Under Secretary for International Affairs at the U.S. Treasury in the past. Our third panelist is Joseph Gagnon, Senior Fellow of PIIE. He had a very rich work experience in the past, including at the Fed and Treasury, and also taught at universities. Let me first, without further ado, invite Professor Huang to give a brief introduction of this Jingshan report. Please, Professor Huang.
Thank you, Mr. Chairman. Again, everybody, welcome to the lunch talk. I was asked to present or to launch the report, so this is a very thick report. I won't be able to go through every detail of it, but I'd like just to say a few words about the report itself. Jingshan report is an annual research project. So far, we have signed a contract for 3 years, so in the minimum, we'll do it for 3 years. Whether or not we'll continue, we don't know yet. It's a very time and energy-consuming process, as you can imagine. But anyway, the subject for the first report, it's called the 2017 report. We started the process at the beginning of the year, tried to find a theme that would interest all team members and obviously, hopefully, would also interest our readers when we finish the project. At the time, the topic was called Financial Opening in a Deglobalizing World. And I guess it's relatively straightforward, the rationale behind the selection of the topic. There were a couple of reasons why we thought financial opening at the beginning of last year was a particularly important issue. Financial opening has been ongoing in China for a very long time, as some of you probably would have realized. But at the beginning of last year, it was slightly different. Part of the reason was, we had a big financial crisis, and there were questions raised if further financial opening would be in China's interest, particularly given what happened the last 2 years. Against the background of exchange rate volatility, the central bank and the Chinese authorities introduced a number of measures over the cross-border capital flows and so on. For some, this was simply for the purpose of financial stability. And for others, they thought, maybe China was actually walking back in the direction of capital account control. So that was one big question. The second very important question, obviously, was, we always implicitly or explicitly modeled our financial reform on the advanced economies in Europe and in the US, the OECD market models. But suddenly now, the OECD models didn't appear to be working perfectly well. And once the second question was, well, is that model still our goal and still the direction for us to go? The third issue, I think that was an issue that always in the discussion, especially in the Chinese policy context, is that how much liberalization would be ideal for an emerging market economy like China, because the financial opening might actually be good. But you also saw experiences of many developing countries had financial crisis right after you open up the capital account, and Indonesia was our close neighbor, and we all learned that lesson. So there was a question if financial opening should still really be the direction for us to go. So that was why when we had a group of scholars sitting together and we asked ourselves, what will be an interesting topic for us to work on? And we all agreed that financial opening policy for the next phase of economic development would be a very critical question to answer. Obviously, we all had our own views at the time, but that appeared to be a timely topic to a question to ask. And then, well, I'll just briefly introduce the team members. The way the project works was we have a coordination team on the CF40 platform. At the beginning of the year or at the end of the year, we select a theme, a topic. And then we form a research group. And for last year's project, we had 7 research team members, including some of the names you probably would know. Zhu Ming was a former deputy managing director of IMF, and Zhang Yuyan was the head of the Institute of World Economics and Politics at the CAS. We also had 2 actually current senior officials from PBOC, including Director General of the Research Bureau and the Director General of the International Cooperation Department. And then we have 2 additional members from CF40 Senior Fellow. Guan Tao was actually a former Director General at SAFE. And it does look like we have a little bit strong representation from the official sector. But the idea is we participate in this research project in our personal capacities, looking at a very important question and trying to come up with some answers. So I mentioned that this was an issue we heatedly debated at the beginning of last year, and we're trying to settle on a specific topic. And then once the project team was brought together, we had a number of meetings and going through the plan for the project. Essentially, we had 7 different papers commissioned to the individual members and worked throughout of the year. By mid of the year, we put together the draft and write a comprehensive report. So this is why I said that this is more a launch of the report, because I didn't write everything in the report, and none of them are here. So I could tell you what I think is important in the report, but I won't be able to justify every bit in the report. And I can tell you, and I'm sure you would understand, we actually had a disagreement on a number of important policy issues. When 7 economists sit together talking about an important financial opening policy issue, you should expect a lot of disagreement among ourselves. So the comprehensive report was drafted by myself, but I also received lots of criticisms from my colleagues. Even after rounds of revisions, there were still people saying, well, is this what exactly you want to say? So I said, well, we'll all have our own views, but the common ground is very simple. The key message, I think, in the end is very clear. That is, yes, further financial opening, the broad direction is where we want to go. But you look at, for instance, the financial opening last 40 years. As I said, the policy actually has been being implemented for a very long time. But you actually also find a very interesting characteristics. After 40 years of financial reform and a financial opening, we're still asking the question if further financial opening is the direction to go, which really says a lot about what we did in the past. There are some key features we try to summarize of the past experience. And I listed 3 here. Number 1 is, well, it was relatively a slow process, and you saw back and forth in the process. And one good example is exchange rate policy. We always think the exchange rate policy should be liberalized, should be market-based, should be more greater volatility or two-way volatility, and so on. But you always find ourselves constrained by limited volatility of the exchange rate, and actually had some spillover effect on the others as well. The second is, well, in issues, or in some areas, we were actually very ambitious. We made a very ambitious commitment, but the follow-through was much less ambitious. And one good example is you're looking at the opening of the financial institutions following WTO accession. And one big story at the time, I remember in 2001, was that the wolves were coming and all domestic financial institutions would experience huge difficulties. And you look at the proportion, the share of foreign institutions in domestic financial industries, assets or capital, you didn't really see the surge of these numbers. I'm not going to get into the detailed story. Some would say, well, there are reasonable, there are reasons why that's the case, because the foreign financial institutions themselves became more constrained in terms of capital. Some of them decided more to focus more on less capital-intensive business activities and so on. So there are many good reasons why the numbers did not go up as many feared. But there was a question we should ask, and I think it's worthwhile asking. When China joined the WTO, it committed to provide a pre-entry national treatment to foreign financial institutions. Was that implemented rigorously? That's an open question. And lack of policy coordination. So we had lots of openings in different areas and so on. But in the end, you find lack of coordination actually would have consequences later on. And one good example is obviously internationalization of RMB, and we pushed on all fronts. Offshore market, settlement of trade and investment and so on. And everything was doing well until suddenly there was a big concern about exchange rate volatility. And a lot of measures actually had to roll back simply because exchange rate regime wasn't flexible enough. So these were some of the key features we thought would be interesting to, useful to look at. We always had this in mind that financial opening would be the direction to go. But the actual result was much less satisfactory, and there are many reasons we looked at. So should we continue to open? And I'll just put the story, a long story short. Yes, we think the key message from the report is further financial opening is necessary, ideal, and probably preferable for the Chinese economy going forward. Whether you look at the need for innovation, the need for diversifying the risks, and the need to support the real economy, and so on. We think a further financial opening would be necessary. Also, that's necessary in part because now we consider RMB is a part of SDR. If China is serious about participating in international economic governance, then well, further financial opening looks like a necessary step to follow. So we thought that's pretty clear. That's the direction to go. Despite all the setbacks we saw and some of the doubts we raised early on, further financial opening would be necessary. But the next very important point we raised, and we actually agreed as a team, is that maybe we, in some areas, in some ways, we need some new thinking. So I listed the 3 examples here. Financial opening in specific areas. We used a very isolated experimental approach, and experimental approach was a successful approach China adopted in its economic reform in agriculture, in manufacturing, trade liberalization, and so on. But its experimental approach is also a viable approach for financial reform. We think that's something we need to rethink about. There are lots of actually financial reform experimental zones in China if you follow the policy experiment. My own takeaway is none of them are really very successful in terms of financial liberalization, because you can try a household responsibility system on a production team. It's very difficult to try market-based interest rate in just a village. Even if you are able to, whether that experience is extendable to the rest of the country is another question. So we think the first takeaway from our review of the past experiences, maybe this is a time for top-level design, no longer experimental approach. That's the first takeaway. The second takeaway is, well, yes, financial liberalization is necessary, but we also needed to pay attention to the painful experiences of Indonesia I mentioned earlier, meaning liberalization brings benefit in terms of efficiency gain, but it also increases the volatility, which could be very damaging in terms of welfare and so on. So liberalization would be good, but we needed to pay attention to the risks, and this is why macroprudential regulation would be very important. In other words, pay greater attention to the risks, and this is why this is particularly important in areas of capital account liberalization. Free capital flow would be good, but we needed to look at the issue, particularly now in light of number one, autonomy of domestic monetary policy, and number 2, financial stability. So yes, the capital account needs to be opened up further, but it needs to be opened much more prudently, particularly in light of monetary policy independence and the financial stability. The third is one big question I think we also needed to pay a lot more attention. In the Chinese policy environment, we heard a lot about pushing through the reforms by opening up, meaning if we open up our market, it actually could be leveraged as an important force to push through domestic reforms. And many Chinese scholars regard that as a unique experience we learned from WTO accession. In order to get into WTO, you needed to reform your domestic economic institution. And that was a very, very useful leverage for the policymakers. You often also hear the same story, the logic, in the financial sector. We actually have a different opinion. We think that was a useful way of thinking about. But if domestic reform does not follow in pace, you actually could create rooms for greater financial risks. So one good example we obviously look at is you can make whatever efforts you want in internationalizing the currency. But if the exchange rate regime is not flexible enough, all the previous efforts could be wasted at some stage, and you have to roll back because exchange rate stability at some point would actually overrule all other considerations. And that's just the one example. So we think, yes, pushing domestic reform by leverage or by leveraging financial opening is a very useful way of thinking, but the other way around should also come through. In other words, financial opening and domestic financial reform really should come together, not necessarily one lead to the other. If there is a one leading to the other, then it should be the other way around. Domestic financial liberalization should go ahead first, not to wait to let the financial opening to start. So we put all the reports together and we made, I think it's 7 major recommendations. The first is about the policy coordination, and that is in particular is particularly required given the new State Council financial stability and development condition. We really need a lot more coordination, and that's in line with the point I made earlier on. Top-level design now becomes really critical for the next step of financial liberalization. The second is more about maintaining financial stability. So what kind of macro prudential regulations would be required in order to support future financial stability. Then we had additional 5 policy recommendations in 5 specific areas. Individual reports they worked on exchange rate, on opening of the financial institutions, opening of the domestic financial market, cooperation on the external financing, and finally on the capital account liberalization. So I'm not going to get into the details because all are published in this report. But I'll just finish by saying a few words about what to expect going forward, especially in 2018. The report was pretty well received, and a part of the reason was because we actually launched the report at the end of September in Hangzhou, and there was a lot of attention, partly because that time the State Council was actually busily putting together a program of financial opening, and now you already saw the announcement. The government is actually lifting the limit on the foreign equity limit on the domestic financial institutions, and within 3 years, there would be no equity limit at all. And this was the reason why, part of the reason why there was a lot of attention. But that was not accidental, because we consulted with the policymakers, with the economists, with the professionals when we decided on the topic, and we thought that would be something that the government want to work on. So I think what you have seen now is 2 things at least already announced. Number 1 was on the equity limits of financial institutions. That's already been announced. The second thing, which is already also announced by a deputy governor of PBOC, was during the last 2 years or so, we introduced some of the management measures for cross-border capital flows and financial transactions and so on. These were not new capital account control measures, but measures trying to manage cross-border capital flows. And the PBOC said by now, most of these temporary measures have been rolled back. In other words, they're gone now. We're at least back to mid-2015 situation. It looks like just a step back, but I thought it actually, in terms of financial opening, a major step going forward. So these are 2 items already announced. What I think we also should expect is something to happen in the coming year, what I call high probability events, 3 things to watch out. Number 1 is I definitely think internationalization of the currency will re-accelerate, and we will see some concrete steps in the coming months announced by authorities. Number 2, and that's something really is critical, I think we'll see some progress, but I'm not 100% sure if we will see 100% implementation. exchange rate flexibility. I think that is going to increase. PBOC always has this clean float idea in mind, but how quickly we can achieve it, it's a little bit too early to say at the moment. What I'm pretty confident is that in the coming months, we are going to see greater volatility or flexibility in terms of the exchange rate. And the third area we probably will also see measures is opening of the domestic financial markets. So the bond market, the equity market, and so on. These are the areas where the authorities already announced the measures of openness, but sometimes the actual openness, degree of openness is much more limited, partly because of the incompatible institutions, rules, and so on. So my expectation is the financial opening of the financial market, the next step, will probably focus a lot more on the convergence of the market rules and the institutions. So these are the areas I think we should expect. Thank you very much.
Thank you, Professor Huang. Next, let's invite Tim Adams for his comment on this report or the China's financial sector in general. Thank you.
Thank you very much. Thank you for inviting me here today. It's been a while, Adam, but it's good to be back. Thanks to Peterson, and it's always an honor to be here because of just all the luminaries you have sitting at these lead tables. It's always a bit intimidating. But also let me thank CF40 as well. You hosted me in Beijing a couple of months ago. It was a very nice visit. I appreciate all the work you've done. The report is quite good. If you haven't read it, I urge that you do. It is sitting next to my bedside table. It's helpful at night. But it is, look, my only quibble with this is a good report. My only quibble is I wish it were written 10 years ago. It's pretty standard, orthodox, could have been written by the IMF or the Treasury or the UK Treasury, others. It's straight down the line, and it's pretty hard to argue with, although I expect some will, and I look forward to our conversation at the end. Let me, in my just quick 10 minutes, hit on 4 areas. Some of this is surveying our 500 institutions. We actually also have the 30 largest Chinese institutions, financial institutions, as members of the IF. Issues facing foreign banks, issues facing foreign investors, challenges facing Chinese financial institutions themselves. And finally, I want to conclude on what I think is the most important thing, which is Chinese FinTech and the role of innovation, which is really radically changing the way we ought to be thinking about and will be thinking about financial intermediation in China for a very long time. The openness of the domestic financial sector is still limited. We know that. You've talked about that. And lags in most other countries, especially most emerging markets. Foreign banks account for only 2%. That's 2% of total banking assets versus 10% of assets in OECD countries, 15% in other BRIC countries. Foreign banks account for only 0.6. It's not 0.6% of total banking profits. So it tells you something about the penetration rates of foreign institutions. China is among the very few countries that still caps foreign ownership in financial institutions. The financial industry could be a very competitive sector, should be a very competitive sector, not a monopoly. And I say that with Chinese institutions as members. Further financial opening could help with financial innovation. You talk about that in your report, competition, diversification, and further integration in the global economy, all key points which were noted in the presentation. Foreign entry can also help revitalize local financial sectors. We saw that in Turkey in the 1980s and 90s. We saw it in Mexico. It helps with efficiency and a better allocation of capital. And certainly we know that in China, we need a greater and better efficient allocation of capital. Some future generation is going to look back and weep at the amount of misallocation that's occurred. And it's easy to mask when you've got a savings rate as high as you have in China. Foreign penetration, foreign institution, innovation that comes with that can help with better and more efficient, maybe not always most equitable, but certainly a more efficient allocation of capital. The experience of the past few decades show the impact of foreign competition in China has been mostly positive. It has set the standard for best practices and led to businesses such as village banks and fintechs, which I'll conclude with. The policy proposals, some that you've noted, some that I hear from our member firms, lift the caps on bank ownership, lift restrictions on shareholder qualification, scope of business, provide foreign institutions a level playing field, national treatment, remove the required years of operation before doing R&B business onshore, and allow multiple license for foreign insurance companies. The insurance business is a great business. Second, challenges for foreign investors. Here's a great opportunity, and foreign interest in Chinese equities, EM equities, especially small cap equities. I was looking at a Bloomberg screen this morning, is literally off the charts. The market cap of A shares on the Shanghai Shenzhen stock exchange is around 51 trillion local. It's the world's second largest. The share of A share market cap has risen from a mere 1% of the global market cap 10 years ago to 11%, a remarkable increase. The bond market is now the world's third largest, rising from a mere 5% of credit financing in 2002 to 25% of credit financing in 2016. Again, a remarkable increase. Positive outlooks. With the liberalization of capital markets recently, foreign investor surveys, we look at some of the investor surveys, incredibly positive, as I mentioned. In 2017 investor survey, China was among the top 3 core priority for half of the respondents in the survey, up from 25% a year earlier. And nearly 70% of respondents plan to increase their level of investment in China over the next 12 months. Around 75% of fixed income investors expect market access to provide a growing demand and lead to higher volumes over the next 12 months. So enormous amount of interest and pent-up demand. Chinese policymakers' efforts to stabilize the currency has brought down hedging costs, which is good for those looking to invest in the domestic bond market. The onshore FX hedging reform announced last year has also helped to enable foreign investors and public and private investors to hedge their onshore bond positions. The China Interbank Bond Market Direct Scheme also applauded, which creates a new route for international investors beyond the existing QFII and other channels, which have been predominant for the past 15 years. Insurance companies are under regulatory pressure globally to look for longer duration assets, and with a decent yield, have also looked to China and used the CIBM Direct Scheme. Over time, the Stock Connect and the CIBM Direct are likely to become even more heavily used than some of the previous channels, and you talk about the channels in your report than we've seen in the past. And the incorporation of the Shenzhen exchange into the Stock Connect has given foreign investors more exposure to Chinese tech stocks, which, again, are some of the hottest stock interest right now. The Morgan Stanley Capital International Index inclusion of A shares to be added to all country and EM indices could, over time, bring China's weight in the index close to 40%, up from 28% now. So China will play an even greater role in market indices. And with the ongoing issues around leveraged firms, capacity reduction, and defaults, international investors actually are watching with great interest whether or not defaults are allowed to happen. In fact, cheerleading defaults, because we know there's a two-way bet and there's actually market scrutiny and market discipline. There are challenges, however, for foreign investors. The opening up of the domestic market is still incredibly limited. Foreign ownership of domestic equity market is only 5% versus 30% in South Korea. And the foreign ownership of government bond market is only 2% versus 10% in Japan, 45% in Malaysia, 38% in Indonesia, 60% in Mexico, and 35% in Brazil. So comparative to other countries, China is well below. There is scope to expand the Stock Connect program to London and Singapore. There are time-different challenges. And while approved foreign institution investors and central banks have been allowed to transact in the domestic bond market, the Bond Connect has been slow to develop despite easing restrictions on foreign firms. Foreign institutions still only account for less than 1% of the onshore FX transactions. So again, another metric where foreign investors and foreign institutions have a very tiny sliver of the business. 3, challenges facing the Chinese financial institutions themselves. China has 4 of the world's largest 5 institutions. Bank assets relative to GDP is huge, 300% of GDP. The banks now account for 9 of the top 20 most profitable banks and over half of the bank profits made by the top 20 banks globally. But Chinese banks lag their non-financial peers in overseas expansion and acquisitions. We see China corporates going global. China banks are not. China banks failed to effectively support China's outward direct investment scheme. Again, one of the points made in the report. Chinese financial institutions' presence abroad is only marked by commercial banks opening up branches, but branches that are really in the business of remittances. If you look at the business model, it's very simple. For example, the Madrid branch of ICBC, 90% of its business is really just remittances. So there are Chinese presence institutions abroad, but they aren't in support of Chinese corporates. The global presence of Chinese financial institutions is not only lagging behind Japan today, but also where Japan was in the 70s and 80s. 5 Japanese institutions have set up representative offices here in Washington, D.C. In fact, Mizuho had their opening reception just this past Monday evening, but also Bank of Tokyo, Tokyo Marine, Daiichi Life, JBIC. So we see other institutions, from Japan, in this example, setting up a presence not only globally, but in places like Washington, D.C. Nearly 100 Chinese investment bankers and brokers. Out of 100, only one investment bank, CICC, has managed to have some presence outside of China and outside of Hong Kong. And even though China has a very large insurance industry, it is huge. China Life is a member of the IF, and the insurance premium revenues are now the 3rd largest in the world. There's almost no presence by Chinese insurers outside of China. But finally, we do see interest by Chinese investors, especially private equity investors, to seek opportunities abroad because they see domestic market as becoming saturated and domestic prices too high. Finally, let me just close on what I think is really the forward-looking view, which is Chinese FinTech. And we talk a lot about regulatory sandboxes. There's one regulatory sandbox, it's called China. And the leapfrogging and quantum leap of Chinese technology in the sense of mobile payments and consumer finance is really quite breathtaking. In fact, we had a session in our annual meetings on moving to a cashless society, and we saw there's an article in the Wall Street Journal last week entitled "The Cashless Society Has Arrived." It's called China. And so we do see China quickly moving away from cash. Something like half the transactions are now done through electronic means. And using facial recognition technology, machine learning data, and the next wave of authentication, payments and credit risk modeling will give us a vision of the future where no other institutions have yet gone. More consumer payments in Chinese cities are done by QR codes, a barcode that can be scanned, and mobile phones then are used for, then cash or credit cards are used. In 2016, mobile payments in China amounted to 9 trillion, that's with a T. In the United States, it was 112 billion. So it's a factor much larger, and we see it permeating Chinese commerce. China now has 502 million unique mobile payment users, almost as many as 500 million mobile money market accounts found in the rest of the world. The use of cash in China is down by 10%. It's dropping 10% per year, and that could accelerate quickly. Companies like WeChat Pay through WeBank, which is a member of the IF, or Ant Financial, Alipay, are dominating Chinese payments. They actually account for 95% of the payment structure. They are a huge, formidable duopoly. And then there's the concept of total digital life, supported by these 2 payment apps, encompass everything from retail payments to utility bills, ordering taxis, takeout food, money market accounts. It's a whole concept about your life and how you live your life and having electronic support through these 2 institutions. Chinese digital finance is a business model focused on data. Data is the new oil, which make them more like a global digital platform company such as Google or Facebook or Amazon. These Chinese fintechs are also going global. Ant Financial, Alipay, Tencent, WeChat exist and are doing deals with Stripe, which is now in 25 countries. We also see it in Asia. We see it in Europe. Even in the US now, they've done a deal with First Data. So here are some challenges. Data policy is one of those. We have a board meeting coming up in a couple of weeks. I'll have the top 40 largest bank institutions and their CEOs and chairmen. The number one issue is data. Who has it? How do you monetize it? How do you protect it? How do you move it from one point to the next? Data is the new oil. Regulation. We do see a regulatory crackdown in China on some of these internet-related financial activities. How much, how quickly, and what pace does that set for the rest of the world, and how does that spill over into other jurisdictions? And then can Chinese fintechs use their business model using personal data to enter other markets? The US, for example. Can foreign fintechs enter China and compete along with legacy financial institutions in the form of management mortgage business or insurance products? Might we live in a world in which it's not legacy institutions, it's not Bank of America and CIBC, it really is Amazon versus Alipay or Alibaba. If all of you know Singles Day, which is the largest shopping day of the year in China, November 11th, $25 billion in commerce. Alibaba alone had 100 million transactions that provided credit on their platform and provided credit to some 20 million SMEs selling across that platform. These are huge, mammoth financial institutions. They are reshaping the way we think about financial intermediation. And let me just close, just in the FT today, my good friend Hugh Van Stennis says at the conclusion of his piece, a survey of Bain across 22 countries suggested customers are open to potentially buying financial products from tech firms, leaving banks vulnerable. In China, leading technology firms are already moved into banking and insurance at large scale. Ant Financial, part of Alibaba, is already as big as the 9th largest US bank. While central banks fret about Bitcoin, this is what financiers are really talking about. Thank you very much.
Thank you, Tim, for your thoughtful and also quite comprehensive review and comments on Chinese financial policies and also financial industries. Let me now invite our third speaker, Joseph, to give his comment. Thank you.
Okay, thank you. So as Yiping made clear, this is a very comprehensive, wide-ranging report, and I'm not going to be able to, in the limited time, do it full coverage. Fortunately, Tim covered quite different areas from what I'm going to talk about, so that's good. We managed to, without coordinating, coordinate. I'm going to talk about three topics. One is global governance, one is capital flow management, and one is exchange rate flexibility. We all know that before World War II, the international rules of the game were basically laws of the jungle. To some extent, we had gunboat diplomacy and discriminatory trade agreements. And after World War II, there was a concerted effort to really improve on the situation in a way that I think is win-win for everybody, trying to sort of establish rules that protect the less powerful and make it possible to grow. And I think it seems to me that the country that probably benefited more than any other from that change is China. And the report raises the possibility that these rules, much as an improvement as they may have been, still were largely set by the advanced economies. China and other emerging markets are growing as a share of the world economy, and therefore they should have more say in the rules, and I think that's right. And we're starting to see China and emerging markets getting more of a vote, more of a voice in international institutions. It may not be happening as fast as some would like. I actually agree it's probably been too slow, but it's happening. I think Yiping didn't talk about this, but Justin Lin did in the first session. The question arises as to whether the rules that were set by the advanced economies after World War II are tilted in some way to their advantage and to the disadvantage of the emerging markets. And I think that's a valid question. But I guess the question I would have is, what are the examples? Because I don't see, although this is raised, and Justin raised it this morning too, but neither he nor the report actually tell you what it is China would like to have different and how much it would matter. I can only think of a couple small things that wouldn't really be that important. I'd like to know what what China has in mind. How would you change the financial system? I think this is sort of a gap in the report. Certainly, I'm speaking about where we are up till now. Obviously, as we saw this morning also, the possibility of the U.S. actually going off the reservation is a huge issue, which I'm not even going to go into, which would obviously have effects on many countries. But even within the rules, if people stick by the current rules, how could they be made better? How would China do it? I don't know. I have no idea. I'd like to hear. A nitpick now because of the institution where I'm standing is that the report says, in passing, it's not a major part of the report, but that the 2008 financial crisis basically reflects the shortcomings of the Washington Consensus. But it doesn't seem to be conscious of the fact that there is actually quite a literature on the Washington Consensus that was advanced within this institution, and first and foremost by my former colleague, John Williamson, whose name was mentioned this morning. And I think actually, if you look at those 10 points that he espoused almost 30 years ago, they've really stood the test of time quite well. I doubt that the authors of this report would actually disagree with any of them, or maybe one, on privatizing SOEs, but even there, I think one could quibble. The one thing that is not in the Washington Consensus, of course, is open capital markets and financial deregulation of the type we saw. And so I think that's sort of a discordant note in the report. There was not a consensus here on open capital markets, although there were certainly strong voices for open capital markets. I think it's right, as the report says, and as Adam said this morning, that the Asian financial crisis and then the global financial crisis have moved economists more towards questioning capital mobility and the benefits of capital mobility. I think that's right. Sort of a minor nitpick, I guess. But that takes me to my point two, which is, well, then how should we manage capital mobility around the world? And here I want to agree very much with what Yiping said and what the report says both explicitly and implicitly. There's a lot of evidence, as Adam said, that financial markets are prone to excess and they send too much capital into a certain industry or a certain country, and then it has to be unwound, and there's misallocation, and the adjustments are costly. I think it's a lot of, more people have come to the view that maybe it's right for policymakers to try to damp these swings. They occur both on a gross level by sector, but also on a net level. I'm a macroeconomist. I'm going to focus on the net, but that's not to deny that gross flows in certain sectors might be worthy of some action. But the net flows, net flow of capital, is also known as the current account balance. And as Olivier implied in his talk, we probably want to avoid those imbalances from swinging out too wildly away from their desirable levels. And I agree with the IMF right now that, especially for the US and China, the desirable levels are pretty close to zero for these countries, and for other countries they may differ, but I would argue they shouldn't be too large, and certainly for the US and China they should be close to zero. So we are not too far from that. Certainly we are in a better position than we were 10 years ago, but I do think we're sort of at the edge of what would be reasonable, with China having a surplus of 2%, US having a deficit of 2.5%. We wouldn't want them to widen much, and actually some narrowing would be a good thing. So what are the tools to keep these things from swinging out of control? Well, I think the tools are capital flow management tools that are discussed, a number of things which I'll come to, and foreign exchange intervention. One of them sort of directly impedes the capital flow. The other one offsets the net effects of the capital flow on the rest of the economy, and they both could be used. I want to argue that the Tobin taxes, the report talks about, are a much better approach than quotas and restrictions. And this is implicit in the report, but I didn't actually see it in the conclusions, but there's a lot of focus on taxing and things that other countries have done, which tend to be in that vein. But I think what's unique about how China has restricted its capital market from most other countries or the major emerging markets, is the use of quotas and restrictions and rules. It's very much analogous to the WTO and the GATT before that about wanting to get countries to move away from quotas and non-tariff barriers to explicit tariffs that are visible and understandable and have less of a distorting effect on the economy. I think this is where China really differs from, for example, people mentioned the Brazil Tobin tax. So Brazil never put a hard limit on who could enter their market or how much, they just taxed it. I think this would make sense to me for China. We don't want to go immediately to full capital mobility, but the way to go is to switch to these kind of measures. If you look at the long list in the report of liberalization China's done, what it is raising quotas and adding more people to certain categories who can do things within certain limits, and maybe raising the conditionality limits that are based on, you know, what type of asset it is, what type of transaction it is, but they fundamentally remain sort of limits, sort of barriers, not taxes. And I think moving that to a system in which unlimited amounts were allowed, but you just had to pay the tax, and then the tax could be adjusted if too much was going out, I think would be an improvement and a step on the way. So that, I think financial markets would like that too. So I think that's my second point. And then my final point, probably the most important point, is exchange rate volatility. I think the key question, and Olivier really made this point very strongly, much better than I was going to make it, so I wish I had coordinated with you on that, but it worked out nicely. I think Olivier is exactly right that if China fully and completely let go of all capital controls and exchange rate management, the renminbi would be a very volatile currency, very volatile, easily more volatile than the euro and the yen. And so then the question is what to do about it. And I totally agree with Olivier's analysis, but let me stress one point which was true in what he said, but maybe people didn't hear it. The key point to focus on is not the value of the exchange rate, but the level of the capital flow. Okay, and we as economists don't have a good understanding of why exchange rates are where they are and why they change when they change for reasons we really don't understand. Sometimes a large appreciation is bad because it's going to really kill your current account and drive capital flows in. And other times it doesn't have that effect because it reflects some other fundamental change in your economy that you didn't realize, and that markets do, and that you needed to have an appreciation just to keep capital flows the same. So the exchange rate is the wrong thing to look at. It's the capital flows. That's what you should look at. And both capital flow management tools, Tobin taxes as it were, and foreign exchange intervention should be aimed at keeping imbalances narrow. We do have a sense of what a reasonable long-run sort of net capital flow should be for the major countries. Okay, so I think Olivier would agree with that, but it's just hard as policymakers because the public gets so focused on exchange rates, it's so visible. Capital flows are something that are sort of in the background, but they're what matter. So in this world, I think allowing a lot of flexibility in the exchange rate, much, much more than China has, while keeping an eye on capital flows is the way to go. Monetary policy would then be free to focus on domestic growth and inflation, which is what China wants and makes sense and has been doing. And by the way, I think there's some research cited here by Helene Ray about whether countries really can have monetary independence if they have open capital flows. I think she's wrong. I think countries like Canada and New Zealand have independent monetary policies without capital controls. But I do think that it is justified to put some capital controls on and use foreign exchange intervention to further damp these swings. So, it's not inconsistent with what she's saying. Therefore, the key for this to work, and this is the final point I want to make, is that you not have a currency mismatch. And what I mean by this is that households corporations and the government and local governments or whatever in China or anywhere really should not be borrowing in foreign currency, except with the limited exception of those firms that have exports and only in proportion to their export revenues. Putting that exception aside, basically we should not have borrowing in foreign currency. And the good news for China is that there isn't that much of it. What China did have largely was paid down in the past couple of years. It wasn't that big. China doesn't have original sin. It's always had domestic currency lending markets, some of the biggest in the world. So they don't need to borrow in foreign currency. And this is an area where I think the kind of macro-prudential tools that Adam was talking about should be applied very firmly. I mean, I think either such risky borrowing could be taxed, or it could be just outlawed. I wouldn't consider that a capital control. I would consider that just a prudential regulation. Households have no business borrowing in foreign currency. We've seen it around the world. It's ended in tears so often. Just forbid it. And it's not an essential part of general opening to the world and capital mobility. The beauty of this is, once you do that, if you don't have this mismatch, then the exchange rate, as volatile as it may be, is stabilizing in the sense that when you have a bad shock and the economy turns south, the exchange rate depreciates, and that is an unambiguous benefit for your economy and vice versa in good times, and that is stabilizing. If you have this mismatch, what happens is that firms and households have to devote more and more of their revenues to debt service. They can't spend as much. The spending drops in the economy. It becomes destabilizing. And we've seen that over and over again. And as long as China can avoid that, and it has nothing to fear from exchange rate volatility per se. And final point, if to the extent that one worries about exchange rate volatility still, taking measures to damp capital flow excesses will actually help at the margin in damping exchange rate volatility. It will be a side effect, a beneficial side effect, and one doesn't want to focus on it too much, but it will tend to go in the right direction. When you have too many capital inflows, that probably means you may be overvalued. If you cut down those capital inflows, you will cut down the overvaluation. It will help in the right direction automatically, but without focusing on the particular value of the exchange rate. So I think I will end there. Thank you.
Thank you, Joseph. Yeah, please. We still have some time left despite our late start for this session. So let me introduce all the panelists to the podium and we can have a Q&A session. Thank you. It appears that the views in this session were very clear, so it's hard to ask any questions.
There's one brave
Oh, yeah,
soul.
that would be great.
Hi, I'm Stephanie Siegel from CSIS. Thank you all for the presentations. And I guess since there was time to ask this question, I'm wondering, not to put Tim on the spot too much, but if anyone were to make the case in favor of allowing foreign currency borrowing, and I was just saying to the person next to me, it's interesting, if we were here 20 years ago, the range of recommendations, I think, would be very different. It feels like we're in a much more, I guess, conservative, measured time, and that could be for good reason. But I'm wondering kind of what the counter argument is, and maybe, Tim, from the perspective of your constituents at IIF, what would be the case for continuing to allow foreign currency borrowing? Thanks.
Sure. I probably have become much more mellowed in my older years as well. That's why I said I don't disagree with much in the report. I have no problems from a macro perspective of thinking of conceptually about capital controls given small open economies and trying to avoid the disruptive nature of huge and sudden flows inward and outward, especially in countries where the financial infrastructure isn't sufficient to intermediate those flows in either direction. My concern is at the micro level, and a little bit, we're sort of getting there. And I was thinking about the CFIUS process, which Adam mentioned, I guess was a product of the conversation earlier this morning. It's fundamentally focused on national security, but if you try to set up a similar screening process where you're trying to preclude foreign investment for economic reasons because you want to minimize volatility, and Adam talked about real estate, but it doesn't have to be real estate, you can pick any sector. I worry about what that actually looks like in the real world. And does it lend itself to rent-seeking behavior and protectionism where domestic legacy industries look to protect themselves from foreign investment, and the disciplining and all that comes with foreign investment, the innovation, the ideas. And so, at a macro level, we're Tobin tax, but I'd rather do that than other forms of non-tariff barriers. But it's how do you operationalize that on a sector-by-sector, industry-by-industry basis? Who decides what FDI is good, what is bad, how is it decided, how transparent it is? And so that's my concern. I like the ideas. I think we are in a more conservative era in the post-Great Financial Crisis, but I think we ought to avoid setting up these instrumentality that will only lend themselves to political manipulation and potentially outcomes which we will find equally abhorrent.
Gregory Ho from Radio Free Asia. Congratulations, Mr. Huang. This question is to you. As a top Chinese economist and strategist, I think you're the most appropriate person to answer this question. I remember a similar time last year when Justin Lin came to town. He talked about the strategy of the Chinese financial system is to lower the leverage, and we see that things really happening. That same time earlier last year, in the Four Seasons Hotel, some Chinese financial gangster, which have too much leverage and their company are too big to fail, have certain very mysterious treatment. Let's say the Mingtian Group, Xiao Tianhua, was kidnapped from Four Seasons Hotel in Hong Kong, according to the surveillance videos. And later on, we see Anbang, and also triggered by Guo Wengui, HNA Haihang. All these are the companies that have too much leverage and overbuying properties outside. And it happened really that Justin Lin gave us the insight that what the Chinese policy maker, especially the financial governing bodies, is looking at. So in 2018, can you give us some insights that what are the targets of this year? What are the, let's say, financial gangsters that, what kind of company Chinese watch body is going to looking at it? Thank you.
You're asking an interesting question that actually I don't think anybody in this room could answer. But I think I certainly have no knowledge about what the regulators are after the next step, especially with regard to specific companies. I have no knowledge to make any informed comment. But I think just generally what you find, it's easy to catch what the policymakers want to do. Ever since about a year ago, they're talking about preventing systemic financial risks. And in that regard, you are actually seeing a number of policy actions we saw already. Establishment of this new Financial Stability Development Commission under the State Council, I already mentioned, mainly for policy coordination. Some of the new regulations rolled out for wealth management products, the shadow banking activities, and so on. also including the FinTech. Tim mentioned about the FinTech, which is really playing a great role in allocating resources and leading financial innovation. But this is a double-sided sword. FinTech is making some help in particular front, but at the same time is also causing a lot of new risks. So my own view is that the one of the key role for the new commission and the regulators in the coming year is to bring full coverage of regulation on all financial transactions, financial activities, and so on, just to keep the risks checked. And I think this is something the government is looking at. You mentioned the deleveraging. I think deleveraging is probably still something the government will continue to work on, although we need to be very practical and realistic about high leverage number we talk about. This is a very high number, but you need to look at the different sectors of the economy, and you tend to find the highest leverage ratio is in the non-cooperative financial, non-financial cooperation. And within the non-financial cooperation, leverage is much higher for the SOEs than on non-SOEs. So I think it's quite clear if you do see a risk in that particular area, where you should find the problem and what kind of actions you should take. There are a lot of discussions about the so-called imminent Minsky moment in China, partly because the leverage ratio at the aggregate level is already so high. My own view is that I think it's very unlikely, partly because of the balance sheet issue. Large SOEs are very highly leveraged, but they're state-owned companies, and I don't see immediate collapse. The biggest problem, challenge, in my view, is declining efficiency and declining output response to capital input. So I think there are lots of things the regulators have in mind this year, but the key word is to prevent systemic financial risk.
Hi, I'm Brad Setzer at the Council on Foreign Relations. This is for Dr. Wong, but anyone can happily answer it. One of the recommendations of the report is to proceed further with exchange rate flexibility. The last time China moved forward with an exchange rate reform in August of 2015, the effort to increase flexibility was interpreted, perhaps wrongly, as a signal that China wanted a depreciation. How would you recommend moving forward with exchange rate flexibility in a way that doesn't introduce strong expectations of a desired depreciation?
I think that's a very interesting and important question, how to manage the transition. Now, you look at the exchange rate regimes in Asia, and you find most countries' exchange regimes are much more flexible than China's. And they don't appear to have a bigger problem. But I think the point you're hinting early on, which is a valid one, that is, in a country where exchange rate regime is very inflexible, once you increase the volatility, you actually encourage herding behavior, and that could lead to some undesirable results. So that, I think, is something we need to work on very carefully, on top of the recommendation that we needed to increase volatility. Part of the strategy, I thought it could just be a gradual transition, meaning, well, you don't necessarily have to announce what is going to happen, but you reduce direct intervention in the market by the central bank and let the market gradually determine the range of the exchange rate volatility. There are lots of concerns about increasing in the exchange rate, especially early on, for instance, when people worry about a number of things, hurting the export sector, difficulties to hedge, and so on. I think these issues can be dealt with once the exchange rate start to move. exporters will hedge and the corporate sector will will do something to protect their interests. So hopefully it's a gradual process moving toward a greater exchange rate volatility. It's not our recommendation that you do it overnight and from tomorrow everything will be done. I think this is a very it's a very sensitive policy implementation, but just look at what is happening in other countries and what is happening during the last 2 years, or certainly last year. I think accepting exchange rate volatility in China shouldn't be too difficult.
May I just add that, Brett, to your point, the importance is communication. If you remember the event that you cited, I don't know if the PBOC put out a 3-word statement, and then there was curiosity over about 3 or 4 days, and finally Yigong was kind of pushed out to say a few words. And I think part of it is whatever the policy is, however it's sequenced and however it's choreographed, there has to be some messaging, communication, some transparency, some sense of here's the conceptual framework, here's where we're going, but a willingness to explain the policy and how it will be managed in the future. And I think it was that silence, and then the markets were filling the void with every imaginable scenario. So communications is key.
Definitely. Also, I guess the picking of time could be critical, because the reason why in mid-2015 the reform led to encouragement of massive expectation of depreciation was because at the time the market already had the pressure for the currency to depreciate and the economy was actually moving downwards. So at that kind of time when you say, well, I'm trying to introduce some new reforms, and a lot of people just interpret it as a way of cushioning growth slowdown. Just looking back, I would say that might not be the best time to start the reform. So lots of things you can do.
Absolutely.
Just to add a point on the timing, that was about 2 months after the stock market rout. So the timing is indeed questionable. Thank you.
One little point, not on timing, but on communication. Around the world, and including in China, if you go to exporters and you say, how much of an exchange rate appreciation could you tolerate, and they'll tell you that if the currency rises by 10%, they'll be wiped out of business and they'll go bankrupt. And over and over again, that's just proven to be wrong. I mean, that doesn't happen. The euro rises 50% from 2001, 2005. German exporters weren't wiped out. Yen did the same thing. Repeatedly, we see that exporters have the ear of governments, and they say things that sound plausible, but actually the data show they're just wrong.
Isn't that part of the problems? I mean, I think this was raised this morning in the context of thinking about capital flow management policies, right? And the principle, well, other than debates about sort of how they operate and how effective they are and so forth and so on, which I guess we now think they're somewhat effective, but maybe not magic, depending on the country. The principal argument against them is they tend to be used as substitutes for other policies, right? And that gets you into the same box, right? And in a way, you're then, then you're in the same box, and then you have a situation in which you have a second or third best situation in terms of them, and I mean, I've always, or at least in my recent incarnations, the last 15 years, been in favor of being more pragmatic about capital flows, and I certainly endorse the posture that the fund now takes on that. But that there too, they carefully say, more in the terms of last resort. It's not always clear to me that last resort is exactly right either, because if it's a last resort, you probably pretty far up the creek without a paddle. But not in place of other more sensible policies that you could do, and that's, I think, is always the tension, and it includes the tension in terms of how things are greeted in the rest of the world. I mean, you have, so you put on capital inflow controls to protect the appreciation, to protect your exporters, right? And then you have a problem that maybe you're providing too much protection from the healthy level of competition. And there is always the question of how do you undo them? I mean, people who are as old as I am remember that we had capital controls on outflows for a decade. And it took us a long time, especially after it was decided that we should get rid of them. It took us another 5 years to actually fully get rid of them, because they end up, I think one of you referred to this, they end up generating their own, I think Tim did, their own rents, right? They end up generating their own rents, and the beneficiaries of those rents don't want them to go away.
Well, I agree with you, Ted, so I have nothing to add. They're not meant to be a substitute for good policies in other areas, and we have to think very carefully about which policy is best suited for which circumstance. I only think that China would be better suited by moving away from these sort of control type things where the government is saying who can do what and how much, to just a tax where they can do whatever they want and just pay a moderate tax. I think they prefer that. It would be better. It's a stepping stone. I don't know.
Well, just to support what Joe said, the kind of capital, cross-border capital flow management measures we thinking about is not the specific, like which capital should come, which capital cannot come, and so on. We're more thinking about in terms of macro-prudential regulation. So this is why Tobin tax would be useful way of thinking about, certainly could slow down short-term volatile capital flows. But in my view, that would not be targeted at specific sectors. It's more like slowing down short-term capital flows and to preserve maybe better financial stability. But I think the point you're making is right, and certainly we see a lot of examples. Once one control measure is in place, you could easily create vested interest groups and so on. But here we're more thinking about liberalizing the capital account, but for the sake of monetary policy independence and maybe financial stability, introducing some prudential regulations.
And again, in terms of timing, I think this session has a perfect timing to end at 3 sharp. So thank you again to the 3 panelists. Thank you for the audience. Thank you.
Nicely done.
Really insightful. One is the focus more on capital flows than on exchange rates. The other thing I needed to think a bit more later on is about household.
It's Nick Lardy. No, that person's third. Then it's Jeff and Gary, and then it's like Sean something. It's like GAO is their last name.
Well, just We would like to move directly to our next panel. We would like to move directly to our next panel, so if you can resume your seats, we will get underway. And maybe the panelists could come up and take their places at the table.
Oh, so this is permanent?
Can I ask the panelists for our final panel to take their places at the table, please? I think we've had a number of very interesting panels talking about various aspects of policy, particularly in China, but more generally the use of monetary policy globally, coordination, and so forth. Then we had this very useful discussion about the Jingshan report and the path to greater exchange rate flexibility and more capital account liberalization. So now we're going to turn to specifically to U.S.-China economic relations. We have 4 speakers. I think, I'm told Gary Huffbauer is in the building, but he will join us, I hope, along the way. We're going to start, we will go in the order that they're listed on the program. I would just make a couple of words of introduction. I think most of you know our speakers. Dr. Gao is on the CF40 Academic Committee, and he's a chief economist at one of China's I think kind of private or quasi-private securities firm, public, okay, Essence Securities. Ha Jiaming is a senior fellow at CF40. I think his position reflects what Adam mentioned this morning, that CF40 is evolving from what we might call a virtual think tank, a society of interconnections, to an organization that has a substantial intellectual capital in-house, so to speak. I think they're going to continue to move in that direction. Jeff Schott has been with the Institute for many, many years, one of our leading specialists on trade, and Gary Huffbauer, when he joins us, is just retired, or not completely retired, but moved to a non-resident status and won't be in the building every day, as he has been pretty much every year since 1992. So we will begin with Gao Shanwen. And I'd like to ask each speaker to limit their remarks 10 to 12 minutes, so we'll have time for discussion.
It's my pleasure to be back here. I'd like to share with you my observation and viewpoints regarding some ongoing economic development trend in China and its possible impacts on the world. And to be specific, I'd like to talk about two important issues. The first one is the ongoing supply-side structural reform. And the second one is the real estate market. First of all, about the ongoing supply-side structural reform. I separate the industries into two groups. The first group in the red line here is those industries which is affected by supply-side reform, which accounts for roughly 1/3 of industrial output. And the figure in the blue line includes all those industries which are not affected by supply-side reform. And the data is from 2006, when the earliest data was available. And we can see very clearly from this chart that from 2006 through 2016, the red line and the blue line basically is the same. They follow the same trend and their growth level is basically the same. However, since the introduction of supply-side structural reform in early 2016, those two lines diverged very significantly. On the one hand, the red line decelerated from roughly 6% annual growth to almost zero, 1 to 2%, almost zero, while at the same time, the blue line picked up and accelerated a little bit or quite significantly. If we can take the historical pattern to guide us to make some guesstimation, then one reasonable speculation could be that without structural reform of supply side, the red line will at least be as high as the blue one, which would suggest that the real GDP growth last year will be close to 8%, rather than the less than 7% just mentioned earlier by Dr. Liang Hong. And as for the industrial output, the supply-side structural reform from this pattern at least depressed the industrial output at least by 2.5%. And it's also likely, and we can speculate that how was the gap filled? The gap between the blue line and the red line is quite large. And how is that gap filled? We could speculate that this gap was filled during past 2 years by increased imports and shrinking trade surplus. If this is the case, we can speculate that the supply-side structural reform contributes to roughly 1 percentage point as a share of GDP to the shrinking of China's current account surplus, or contributes to the world growth by roughly 1 percentage point as a share of China's GDP. It's possible people may argue that the divergence could be attributed to divergence in demand rather than supply-side reform. And from the evidence we are going to investigate below, we could argue that that could not be the case. This is the elasticity of price, to be specific of PPI, industrial price, to the change of industrial output. We calculated the elasticity for the past 16 years. The method is that First of all, we calculate the extent, the degree from the bottom to the peak of PPI change and industrial production change. Then we calculate the elasticity. We can see that before 2016, the elasticity sit between 1 to 2, roughly between 1 to 2. However, for this round, the elasticity is as high as 3.2, much bigger than the historical pattern, which suggests that it could not be the case that the demand divergence contributes to the divergence in the industrial output. And we also know that in the past 2 years, China's fixed asset investment still continued to slow down, even significantly. And we also know that the domestic consumption at most stabilized at the current level. And we also know that China's export was recovering in the past 2 years. All of these trends suggested that during the same time, China's trade surplus should be increasing significantly because of the slowdown of domestic investment, because of the pickup of export. However, if we calculate the real trade surplus of China as a share of GDP, which means that we calculate this level at the price level of 2006, both for surplus and for GDP. Actually, during this same time period, the trade surplus shrinked by 0.5 percentage point as a share of GDP, which is consistent with my early interpretation that the structural reform of supply side contributed to the shrinkage of current account surplus, and the degree could not be smaller than 0.5%. And my speculation is that it could be between or around 0.8% as a percentage of China's GDP. So to conclude my first issue, my basic information is that if China had not introduced supply-side structural reform and early 2016, China's real GDP growth could be very close to 8%. It picked up significantly from the bottom level of roughly 6.6 or 6.7 level. However, because of that reform, China's GDP growth was depressed. However, at the same time, the current account surplus, or at least the trade surplus, was shrinked significantly, which contributes to global recovery, which also may contribute to the upcoming trade dispute between China and the US on steel, on aluminum, and some other items as well, since steam, aluminum are among the key industries which was aimed at by structural reform of supply side in China. And the second issue I'd like to talk about is the real estate market, the development of real estate market in China. Some people in Wall Street said that the real estate market in China is the most important market in the universe. To be true or not true, it's quite clear-cut that real estate market in China is very, very important. However, I'd like to share some observation and viewpoints of mine regarding the most recent development in real estate market and its upcoming trend. First of all, and to be brief, I'd like to share with you the inventory level of China's real estate market as their share of total assets for all listed companies of real estate sector. And we can see that ever since the financial crisis of 2008, the China's inventory in real estate market accumulated significantly. from 2009 through at least 2011. And it continued to build up a little bit through 2014. However, ever since the second half of 2014, the inventory level as a share of GDP dropped very, very significantly. And at the time of the last quarter of last year, actually the actual inventory level of China's real estate market has gone back to the level before the crisis. And actually the precise data suggests that it is a little bit lower than the level before the crisis. And we can see with some confidence that China more or less has finished the process of destocking of real estate market, which is going to have some major consequence on China's demand trend and China's import or trade surplus with the world, which we are going to see in the quarters to come. But before I can jump to that conclusion, I'd also like to share some other charts, which is also relevant and important. And this is the inventory level I calculated for the national level across all towns, across all cities, first-tier city, second-tier city, and third-tier cities and below. And this is from a different data set from that of listed companies. However, the trend is very, very similar. The inventory level peaked at 2014, and then it dropped very, very significantly. And for the moment, for the time being, the challenge is that the inventory is too low rather than too high. So we have already seen price jumps in many, many China's cities, not just the first-tier cities, not just the second-tier cities, but more and more in third and even fourth-tier cities. The price of the real estate is jumping up, reflecting the underlying destocking process has already more or less been finished. Here, I calculated the gap between the sales of real estate and the volume of new starts of real estate. When the market is destocking, this gap is negative. When the destocking is finished, this gap will go up and enter the positive range. And from this viewpoint, we can see very clearly that from 2014 through only 2017, this gap consistently lying at a very negative range. However, in the second half of last year, it picked up a little bit, and now it's basically zero. And this is for second-tier cities. And for third-tier cities and below, the trend actually is quite similar. So the finish of the destocking of real estate market is not just reflected in the inventory level, it's also reflected in the gap between the sales and the new starts of the real estate market. And as a result, here, this chart illustrates the revenue of land sales as a share of local government's revenue. Because of the finish of the destocking process, we can see that the land sales revenue rise up very significantly, and I suppose it will continue to rise for some quarters to come. So the data is quite consistent from different angles, from the land sales, from the gap between the sales and the new starts of real estate, from the inventory level. The information is quite consistent that the destocking process has been more or less finished. However, before the real estate market can contribute significantly to China's recovery and the global recovery, we have to pay some attention to the demand side of the real estate market. Here is the sales trend of the real estate market on the demand side. And this red line and the blue line, the difference between the red line and the blue line is the policy effects of the renovation of shantytowns. Many people argue that that effect is very, very big. Actually, if we trace back the data to the very early starting points, it's not that big at all. And the trend is quite clear-cut, quite clear, and the trend is basically similar. And from this chart, the basic information is that in the short term, the volume of sales of real estate market fluctuated very significantly, partly because of policy intervention, but more importantly because when the market deviates significantly from the long-term trend, at some point it will go back to its long-term trend. And the long-term trend is very, very stable. The long-term trend is basically between 5 to 10% of annual growth of the sales. So in the short term, we can see that the sales is still coming down. However, history pattern suggests that it may stabilize at the second half of this year, 2018, and then begin to pick up. And so for next year, even for the second half of this year, we will see that China's real estate investment will begin to be normalized, will begin to pick up even quite significantly to contribute to China's demand recovery and that of the global recovery, which will contribute to a more balanced trade surplus between China and the US, or even China and the world. And I have used up my time, and I conclude here. Thank you.
May I have the, oh, yeah. It was, I don't know how. Push it down. Go? Push it down? Anyway, let me start talking. Thank you. Before this thing works. Oh, yeah. That's great. Okay. Yeah, thank you. In the past 2 years or so, I kept asking the following question to mostly market participants, market economists. What are the biggest risks this year? Many Chinese market economists or strategists point the finger to the US, a US stock market correction or meltdown. They think the largest risk comes from the US. But when you talk to similar group of people in the US, they said the largest risk is a hard landing of the Chinese economy, triggered by debt crisis, whatever. But fortunately, neither materialized. Then you ask them, what are the longer term risks? Chinese economists would tell you a Japanese kind of secular stagnation. I think Justin Lin just mentioned that this morning as well, right? But quite a few American economists would say it's a Chinese economy falling into the Japanese kind of a trap, experiencing lost decades for a few decades. Actually, I think many of the Japanese felt quite comfortable in living in the past 2 decades. At least they had much lower income inequality. And when they compare to China, they will say, we got rich before getting old. Are you gonna getting old before getting rich? So I think this, different views compare reflected some kind of misunderstanding of the two economies. In my personal view, the largest or the greatest risk is policy mistake from one side, which could end this synchronous recovery in both countries, if not the global economy. And that kind of a risk, according to my meetings in the past 3 days in this town, seems to be on the rise. So I think here it will be useful to highlight, actually to reiterate, the importance of China-US economic relationship. First, on trade. The two economies are getting increasingly intertwined. The US is now the largest trading partner of China. Now, at one point in time, European exceeded the United States to be the largest. But now, again, US is back to the #1 position. And also, overall, China had a trade surplus against the US. But if you separate trading goods and from trading services, China actually had huge, quite significant trade deficits against the US in service trading. And actually, this deficit in service trading is getting much bigger, and it is growing faster than the trade surplus in goods against the US. Also, look at the direct investment. Direct investment in China increased dramatically. Direct investment, Chinese investment into the US increased dramatically in the past few years. So people may worry about China investing now more in the US than the US investing in China. However, the Chinese investment in the US took place only in the most recent years. On a cumulative basis, the US investment in China is way higher than China's investment in the US, as shown in the second chart. Of course, the investment through China's foreign exchange reserve holding is still at a very high level. Again, here, 2 years ago, China was taken over temporarily by Japan as the largest treasury foreign holder, but now China resumed the #1 position. Financial reforms, I don't want to repeat what had been said in the previous session, so I would jump this slide. I want to highlight the interdependence of the two economies through the financial channel. Many people think that China depends more on the US through the trade channel than the US depends on China. That's true. But also, one important link is the financial markets. In the past, when China's economy, or even during the Asian financial crisis, the meltdown of the markets in the region didn't impact the US. However, in the most recent period, a very small devaluation, 2% devaluation of the renminbi, and also 2 months earlier, the meltdown or the stock market rout in China triggered massive volatilities around the world, including in this country. So the financial channel should not be underestimated. Now, policy link. China used to have its very closed capital accounts, and monetary policies does not seem to respond to the change outside of China. But more recent period shows that that's not the case anymore, right? China may not directly lift the policy rate, but through other instruments, the central bank in China has been very responsive to US interest rate hikes by lifting the short-term interest rates in China. And more importantly, the regulatory tightening that we have observed since last summer when the Financial World Conference took place seemed to point to a tightening of overall monetary stance, not necessarily through the change in base money, but through the change in regulations. So I think there's a kind of a synchronization in monetary policy as well. And to be honest, I do think China can make a strong case to raise its interest rate at this moment, because inflation is actually picking up and interest rates remain very low. Secondly, China wants to reduce financial risks by constraining activities in the shadow banking industry. This could be done through administrative measures. You can close some of the institutions or prohibiting them from doing things that you don't want to see. But ultimately, why people want to buy these kind of wealth management products? Because they offer slightly higher interest rate, maybe 4 to 5%, but in deposit rate is lower. So I think a more effective way of regulating shadow banking or wealth management products is still through the price channel, not necessarily rely everything on administrative measures. So interest rate needs to be increased even from a financial stability point of view. Well, tax reform, this is data by the World Bank. It shows that China has the highest tax in the world. If you include both the direct and indirect taxes, they account for a combined 67.3% of total corporate profits, compared to around 44% in the US. So even without the US cutting its own taxes, there's a strong case to be made that China should reduce its tax rates. So this reform in the US could give some important food for thought to the Chinese authorities in thinking about its own tax reforms. Now, on the two economies, I think many people are increasingly willing to point out the competition between the two economies. I think competition is natural compared to a few decades ago. Back then, China is a country full of labor, but in lack of capital. So the foreign investment providing capital, it's a natural marriage with China's abundant labor supply, low wage rate. But now things have changed somewhat. China still has a lot of labor. Labor productivity is still growing. Of course, wages are rising also at a very rapid pace. But more importantly, China also has a lot of capital. And the Chinese economy also wants to, Chinese entrepreneurs also wants to have their own companies, their own brands. So the relationship that we observed in the past has been changed. And this is I think is a natural development. As a country gets rich, it wants to have its own industry, its own markets, etc. So I think this is something we need to bear in mind. Talking about the comparative advantage, I think, yes, the US productivity is much higher than in China, although it is now stagnating. I don't know whether it's due to data problem or some other problems. But if you look at the share of labor or unit labor cost, China is still very, very low. So this kind of a comparative advantage didn't change materially. Now, another complementarity between the two economies, I think, is in certain sectors. For example, one is in the online trading sector. The other is in infrastructure. Now, I think some of the speakers this morning also highlighted the rapid development in China's e-commerce and online payment. These figures probably need to be updated because they are changing every month. But the number that I have is online retail now accounts for about 13% of total retail sales in China, compared to 8% in China, in the US. Looking forward, I think the ratio will continue to increase. And some anecdotes suggest that the online retail in China is extremely efficient. I think that's probably one of the reasons the one internet company earlier last year even proposed to do more business in China, in the US, and helping the US employment growth. Now, on infrastructure, high-speed railway is a case in point. If you look at the overall length of high-speed railway in China, it's now 22,000 kilometers. Right? In the US, I think the number is, I don't know. My assistant gave me a number 0. So there are areas that China and the US can cooperate. The complementary nature of the two economies should not be ignored when we encounter some kind of competition. Okay, I will stop here. Thank you.
Well, good afternoon. I'm Jeff Schott, and I'm going to present the first half of this slide on the outlook for U.S.-China trade and investment relations. First, we want to thank Lucy Liu, our research analyst, for her contribution to this PowerPoint and to our trade research more broadly. I don't know if Lucy is here, but if she stood up, she should be recognized, because 10 or 15 years from now, she will probably be up here on the platform speaking. I don't know whether she'll be speaking on behalf of CF40 or the Peterson Institute. I hope for the Peterson Institute. You also may have noticed earlier today, when we were talking about Chinese monetary policy and financial markets, that the room got really hot. By the time Gary and I finish this presentation on the outlook for U.S.-China trade and investment relations, there will be a distinct chill in the air. I'm having the same problem. Down. Okay. There we go. So the first thing to start with is just a simple table on U.S. bilateral trade with China. The left-hand side is U.S. exports. The right-hand side is U.S. imports. And the only point to make here really is that U.S. exports are diversified. About 2/3 of U.S. exports to China are manufactured goods and agriculture, about 1/3 services. So about 40 or $50 billion of services, a little over $100 billion in manufacturers and agriculture. U.S. imports from China are almost exclusively manufacturers. And you look at it, and it's nicely presented so that it looks like trade is in balance. But actually, the scale is about 10 times greater on the import side. So there is a very large trade deficit, goods and services deficit with China. A small surplus in services, a large deficit in goods. Most people in this room would say, well, that doesn't matter that much, the bilateral deficit, but the magnitudes are great, and under the current political, given the current political regime in Washington, it is a great focus of attention. And the other point to make on this graph is not only are the deficits large, but they have continued to be large, and in fact, from 2016 to 2017, they have increased. Both the bilateral and the global deficit. And that is going to be, I think, a friction or a flashpoint for the Trump administration as they move into 2018 and see the results on trade from their first year in office. The simple point from this analysis is that U.S. trade relations are not good right now, and they're likely to grow worse in 2018. They're going to grow worse because there's a growing U.S. bilateral and global trade deficits, and that's likely to provoke increasing protectionist responses in the run-up to U.S. midterm elections in November of this year. The U.S. global deficit in 2017 is going to come in at about goods and services of about $550 billion, up from about $500 billion in 2016. The trade deficit, merchandise trade deficit for the United States globally is about $800 billion. Those are numbers that attract attention of people in the White House. The U.S. merchandise trade deficit with China accounts for almost half of the global U.S. deficit and about 58% of the manufacturer's deficit. And if I were to just explain what U.S. trade policy is like in the Trump administration, all you have to do is look at this table. This is what drives U.S. trade policy in the Trump administration. Those 10 data points. Overall merchandise deficit in manufacturing with China, with NAFTA, with Japan, and with Korea. And you'll see the focus on the size of the overall deficit and the contribution of manufacturing. U.S. officials, and this is a really critical point, U.S. officials argue that the U.S. manufacturing sector has been undercut for decades by both traditional trade barriers and regulatory measures that target technology, data, and other assets of the modern enterprise. And they are intent to change it. They use the term rebalance. There is no way that they have the tools in the toolkit, in their trade toolkit, to do that. But they have promised their core constituents they're going to try. And so you're likely to see much more trade restrictions against imports from China. Chad Bown gave a good recitation of the lineup coming up just in the next few weeks on anti-dumping and countervail, on safeguards, and on Section 301. And the use of Section 301 may make Carla Hills look like a piker back in when she used the crowbar to really push open foreign markets and to get the Uruguay round towards its successful conclusion. This is a reinstitution of that Section 301 authority, but in a different climate, as Chad mentioned this morning, where you now have international rules guiding the use of such measures, which you didn't have back in the 1980s and early 90s. There's one other aspect that is also dangerous and needs to be taken into account, and that is the enforcement of U.S. sanctions against North Korea. To date, there has been cooperation between the United States and China, but as the U.S. increases and ratchets up its pressure against China, against North Korea, there will be a case where the Chinese perhaps do not fully comply with U.S. sanctions, even though they may try to comply with agreed UN sanctions. The gap between U.S. and UN sanctions will grow. And that could lead to restrictions against Chinese entities, perhaps state-owned entities, that could be rather drastic in terms of their ability to access the U.S. market. This is a threat, but it's a real one that grows with the growing tension in the White House, not only about commercial relations, but strategic relations with China. And for that, I encourage you to look at the national security strategy that was issued about a month or two ago. I think Gary's going to mention a little bit of it more, but it indicates strong concern in the White House about the overall relationship, both economic and political and military with China, and that gives the uneasy impression that the buffer against excessive commercial tensions or frictions in our bilateral relationship may be eroding. And that's something we have to both be very sensitive to and careful about, both because of its commercial impact, but more importantly, because of the importance of U.S.-China cooperation in the Asia-Pacific region. Now, Gary and I included two tables from Chad Bown. We thank you very much, Chad. He presented this this morning, but it's so important that you ought to see it twice. But what it tells you is that the U.S. imposes a lot of temporary trade barriers. We used to call it contingent protection against Chinese firms. A lot of anti-dumping, a lot of countervail, a large portion of that targeted against steel trade. In fact, it blocks most of Chinese steel shipments to the United States. He also has a very good graph that shows that it's not just anti-dumping that has been the primary tool of this intervention by the United States, but also countervailing duties. And they can occur not as substitutes for each other, but additive. And so that it increases the restrictive effect against Chinese imports into the United States. This is also important because anti-dumping targets Chinese pricing practices. Countervail targets Chinese government policies and support for firms. And so you're getting into an additional layer of friction against the policies of the Chinese government, particularly subsidies for domestic industries. Now, of course, this is most important particularly for the Trump administration in the area of steel. And efforts to try to deal with the global overcapacity in the steel markets has been relatively unsuccessful. table on the chart on the left shows steelmaking capacity, and global capacity has risen very substantially over the past decade. So has Chinese capacity. It's up about 2.5 times, and China's share of global steelmaking capacity is now close to 50%. Now, to be sure, there have been efforts over the last couple of years to reduce capacity, and there has been some gross capacity reductions in Chinese steelmaking. But at the same time, there has been some very small net capacity increases as private firms continue to enter into the market. And so overall, the net effect of Chinese measures to rationalize steel production has been very small. Very slight reduction in global capacity, in Chinese capacity, and so it hasn't made much of a difference in the steel markets. U.S. production has been flat. It hasn't been decreasing. Indeed, besides China, India, Brazil, and Korea are among the countries that have been increasing their steelmaking capacity over the past few years. This is going to be a problem that's difficult to deal with, and Gary will talk about the ways that this is likely to evolve, in part because we don't import steel from China very much. Chinese steel, about half of it goes to ASEAN countries and to the Middle East. And but the increase of steel shipments onto the world market has had effect on world steel prices, and that indirectly affects U.S. steel makers and has led to their concern. And who has been one of the leading, who is one of the leaders in the U.S. steel industry over the past decade or more? Secretary of Commerce Wilbur Ross. Who has been one of the chief lawyers defending the U.S. steel industry over the past 30 years in trade cases? U.S. Trade Representative Robert Lighthizer. So these are people who know the industry very well and are likely to increase pressure as this Section 232 case comes to fruition very soon. Now, the final point I'd like to make before turning over to Gary is on overall trade relations of the United States and China. The U.S. is refocusing its priorities on bilateral trade relations. It has given short shrift to regional initiatives and indeed dropped out of the TPP, the Trans-Pacific Partnership. That has been quite a boon for China because as the U.S. has disengaged, and it has disengaged in the region as a result of its action on TPP, China has been increasing and deepening its trade ties with the other members of the TPP. It has trade agreements with several of those countries. Many of them have gone back to China to deepen those ties, and it is opening new trade talks with countries that it has not yet had trade agreements with. So the footprint of China is going to increase in our own neighborhood and based on our own trading partners who we are basically giving short shrift to. The other factor that is going to be damaging, and this will be my last point, Nick, is the U.S. reaction towards the World Trade Organization. The Trump administration has been sharply critical of the WTO, especially its dispute settlement system. The fundamental problem is that the administration believes the current what's called balance of concessions. That's what we used to say all the time in the GATT and also in the WTO. The balance of concessions is unfair, especially to the U.S. manufacturing sector because of the commitments and the deep liberalization the United States made in the first decades of the post-war trading system. That was done to great effect and great benefit to the United States to help promote global recovery. But now that countries have recovered, and now that new nations have emerged as important players in trade and investment in the world economy, there's more competition. And that seems to be unfair. The way the level of tariffs and the trading rules have been set out now are seen by the Trump administration as a hampering of U.S. manufacturing prowess, even though our manufacturing output is at near record levels. This is something that's affected the U.S. attitudes toward the WTO. Though, to be fair, Ambassador Lighthizer did say at the last ministerial meeting in Buenos Aires a few weeks ago that the U.S. would be happy to pursue plurilateral agreements, particularly on e-commerce and possibly on services. The only problem in this area is that you need cooperation among the major trading nations to have that type of initiatives work in the WTO or elsewhere. And particularly for e-commerce and services, you need participation by China. To make that policy work, the United States has to find a better way to work with China. And China has to find a way to address some of the basic fundamental concerns of the United States, particularly in those areas of services. This is going to be a challenge because as we increase our trade frictions, it's going to be harder and harder to find ways to cooperate on trade. But it's necessary to do that. The outlook for WTO negotiations is not promising. The outlook for U.S.-China trade relations in the short term is not promising. We have to find some way to reverse it, given our mutual interests in working together for economic growth and development. Thank you.
Okay, thanks very much. I'm going to continue the chilly note which Jeff has introduced to this wonderful forum. And we'll start with some slides, and then I will give some comments on why the past is not prologue. So you look at the U.S. outward foreign direct investment stock into China, it's doing pretty well. The blue bar is your manufacturing, and the orange is services, which had a nice uplift through 2014 and is about the same now. These are stock figures, not flow figures, and then the gray is kind of everything else. So that kind of looks pretty good through 2016. And now if we go to the next chart, which is the last chart, U.S. inward FDI from China, that's the left side. 2013 to 2017, Lucy pulled the numbers together. You can see doing very nicely, probably surprisingly quite nicely in services, but manufacturing is not lagging either. And the right-hand side distinguishes between greenfield, which is the blue, and mergers and acquisitions, which is the orange. And as you can see, mergers and acquisitions absolutely dominate, which is true generally of foreign direct investment. About 75 to 85% of foreign direct investment from any place, UK, US, whatever, is mergers and acquisitions. So that's kind of has been the story. And since that was the story prior to the 2016 election, that led groups like Rhodium in saying we are using Rhodium figures for investment in the U.S. They're much better than Bureau of Economic Analysis figures, more comprehensive. That led Rhodium to think that, we're kind of on an upward trajectory, and give us another decade and Chinese investment in the U.S. might approach what it should be based on a gravity model, given the size of the two economies, and our investment in China would likewise grow. And we bought onto that story in our classic book, Bridging the Pacific, which was written in a different era 3 years ago. Now, something has happened in the meantime, and what has happened with the new administration is national security. Now, anybody who has trouble staying awake, and there may be people at this point in this conference who have that trouble, draw down the report by Michael Brown and Pavnet Singh. It was published back in February 2017. I'll just give you the title, and you can fill in the blanks in your mind, but read it. China's Technology Transfer Strategy: How Chinese Investments in Emerging Technology Enable a Strategic Competitor to Access the Crown Jewels of U.S. Innovation. That's the Trump policy. And what that says, well, just to take interject a little bit on the law first, not very much. You know, we have this Committee on Foreign Investment in the U.S., and I think everybody here is aware that there is legislation promoted in both the House and the Senate. I'll be testifying on it next week, which would tighten the screening of investment in the U.S. But in practical terms, the phrase national security, which is the essence of the current law, that is determined by the president. Don't think that there's an independent court standard of what constitutes national security, because if you start looking at the cases, you're not going to find very many, if any, where the courts have said the president overstepped in his findings of national security. I mean, we have sanctioned very small countries, which you can't even find on the map under our national security laws, and we've toppled their governments by a finding of national security, and that's never been challenged. So the elasticity of the current legislation is quite broad, but what the proposal in the revamping of it is to make it even more stringent in case some weak-kneed person occupies the White House in the future. And now, just a political note, if you look at the history of the last century, and you can go to the prior century, the 19th century, you will find that Democrats are just as hawkish, if not more hawkish, than Republicans. And right now, with respect to China, that's exactly what's happening. There are no Democrats who are standing up, or very few who are standing up and saying, you know, we have a great economic relationship here, we should try to deepen it and strengthen it. Oh no, you have people like Schumer and Feinstein, pretty senior senators, who are saying that Trump is weak-kneed on China, that, you know, he's a little bit, you know, shilly-shally. So that's kind of the political context of the moment. Now, the recent decision on MoneyGram was quite interesting because it was turned back. This was the Alibaba attempt to buy this financial firm. It was turned back on the notion that this would give data on lots of individuals who use MoneyGram, like my friend Ted Truman and others, to the Chinese, to a Chinese firm. And, you know, it'd be misappropriated in some way, shape, or form. Well, you take any merger and acquisition, and it probably has some data on some people in this room, and more broadly in the United States. This is a very far-reaching rejection. On top of that, going back to this document by Michael Brown and Pavnet Singh, they have this view that the United States should keep a good, healthy distance. In fact, enlarge the distance in its technology versus China in almost every respect. Now, you know, the high-speed railway does create a problem because it's already reversed, and that is probably true in some other technologies as well. But this document does not want to see any narrowing of that gap. And if you're familiar with the concept, I'm sure everybody here is, of dual-use technology, what you can use, you know, like Google, you know, ably represented in this room, has technology which arguably is dual use, both military intelligence and civilian use. Well, you know, we shouldn't have the Chinese catching up with us in that respect, in that technology, or anything else, artificial intelligence, robots, materials, you know. Anytime there's an investment that would maybe give the Chinese a step up closer to the U.S. frontier, however you define that, and they don't really try to define it in this document, well, that subject should be subject to very intensive review and screening. So those are the proposals, and I want to emphasize that that's embodied in the current legislation which is being considered by the Senate and the House. But already, if the Trump administration wants to implement that kind of screening, it can do it under current law. You can't appeal a CFIUS decision, realistically. Those are secret, held in secret testimony and so forth and so on, presidential authority to do the ultimate blocking or to chill it non-reviewable. So going forward, it really isn't clear in this proposed legislation or how the administration uses the existing legislation the role of foreign availability, because the U.S. is not the only technology center outside of China. And this is a very old issue. It goes back to the Cold War, and Kim Elliott here and Jeff and myself, we looked at this in great detail. You know, we had this COCOM administration back in the Cold War, and we had a Chinacom administration. Since the Cold War, we've had a Wassenaar process. The big issue in all this kind of control is, well, if you can't get it from the U.S., can you get it from the French or the Germans or, you know, somebody else? And that's a lot of debate. But the point is that, you know, what the U.S. first has tried to do in those prior episodes was to persuade the British and the French and the Japanese and so forth not to sell the technology at hand. And then if they do, then what does the U.S. do? Does it limit its companies from participating in the market in question? You can see those are very thorny issues. But there's an awful lot of technology which is available in other countries. Indeed, we might, under the CFIUS draft legislation, be very easy on selling this technology through an M&A deal to the UK, but hey, maybe the UK will go all squishy and sell it to China. So you can see how this could spin out under the present mode of thinking. Now, one thing that the current law does not do, but the new law would do, if enacted the way Senator Cornyn and Senator Feinstein want it to be enacted, would be to control all our outward investment. Not only the inward investment that steals our crown jewels, that's kind of the thinking of these people, but also outward investment that might transfer the crown jewels to some Chinese to a Chinese subsidiary of a U.S. firm or maybe a joint venture. That would be subject as well. That's a huge expansion, huge bureaucratic expansion. And further, it would start controlling export, because not only the investment, but if you had a technology license, that would go in. So you can kind of see that the chill that Jeff talked about in trade is really coming down the pike in the investment area, where the United States has historically been very, very liberal, has pioneered the whole post-war agenda in this area. So we have we've had these talks, I think they went through about 11 rounds or so by the time President Obama left office, called the Bilateral Investment Treaty, BIT. You have to change the meaning of the acronym now, and it would be back-burner interdependence talks or something like that. They are not going anyplace. They're not going to go. And it's not only that the U.S. is closing, but China hasn't been opening. There are a lot of sectors where it's very difficult to invest in China, and it's not getting any easier. Data, everything to do with digital. I'm sure Rory has experienced this, or Farquhar from Google. You know, they're tightening up. putting a digital wall. So we're both going in directions which I don't think are very constructive. Now, it may be that the force of the markets in investment and in trade are so strong that it will overwhelm these government attempts to put up barriers. A few years ago, our chairman here, Nicholas Lardy, wrote a great book, Markets Over Mao. It's now time for some Chinese author to write Trade Over Trump. Thank you.
I want to thank our panelists. I think they've given us a very good overview of the nature of the interdependencies between the two economies, as well as the risks that are currently emerging, not only on the trade front, but also on the investment front. Before we close, there is time for questions, so if you have a question, this is your opportunity. Bill.
Yeah, Bill Lane with WIDA. In this world of bilateral fairness or equality or whatever, I have a question on how you define it. The U.S. has a slight trade deficit with Canada right now, but the average Canadian buys 8 times more products from the U.S. than the vice versa. The U.S. bashes Mexico on a regular basis, but the average Mexican buys twice as much American products as the other way around. So it raises the question, is the problem with trade, or do we need more Mexicans? And in that way, you'd get some equality. On Mexico, or on China, the per capita comparison doesn't really hold up. I mean, there is an imbalance. It is significant. China joined the WTO 20 years ago, or almost, on terms that made sense 20 years ago. No country on the face of the planet has spent more money on infrastructure or education and changed and become more competitive than China has over the last 20 years. So shouldn't the main focus be on trying to modernize the trade relationship as it exists today, rather than how it existed 20 years ago? China doesn't need 9.9% tariffs. The US, for many, many sectors, have 0 tariffs. Can't we do some of this on a bilateral basis in a fairly quick period of time? Thank you.
Sounds like a Gary Jeff question.
No, we can't. There's almost no basis for any of the bilateral negotiations that the Trump administration is pursuing, in part because they do not intend to make any changes in U.S. law and practice. And that makes it very difficult for other countries to go back to their domestic constituencies and say, we are going to pay tribute to Washington and avoid a bigger problem. That's not an exaggeration. If you look at the U.S.-Korea talks, the United States Trade Representative has not notified the Congress of his intent to negotiate because he doesn't think he needs implementing legislation for the agreement that he is going to produce, because he's not going to make any changes in U.S. practice. Korea recognizes that, and I think the Koreans are willing to look at ways of improving the operation of the agreement, but it's not going to change the trade deficit very much. So you're still going to have charges of unfair. And unfair is a political, and fairness is a political term. It's not an economic term, as the way you were trying to characterize it.
Nicolas Veron again at the Institute. My question, which reveals my ignorance, is about the steel market, because my understanding has been that at least on some indicators, for example, stock prices of some of the steel makers, we're seeing a less concerning evolution of the marketplace recently than, say, a year or 2 ago. So could you give us a sense beyond the rhetoric of the Trump administration, whether the problems that US or other Western steel makers are meeting are getting bigger, smaller, or about the same as when this discussion was raised during the campaign? Thank you.
Well, the best thing that's happening in the steel market is that the world economy is doing quite well, and that's obviously ramping up demand. But the U.S. steel firms are not happy, and they have never been happy in the last 30 years, so that's not new. And what they really are looking for is the administration to deliver policies, which my guess, what they really want is policies that lift U.S. steel prices by about 10 to 20%, which of course will hurt a lot of downstream industries. But that's what they want. Will they get it? Well, I think what Ambassador Lighthizer will try to do is negotiate some kind of global quantitative restrictions on steel exports. It's very hard to do, but it's very hard to do it just on the basis of limiting U.S. steel imports. Why? Because we export about as much steel to Canada and Mexico as we import from them. So it's just, as soon as we start cutting that, it's about 4 million tons to each country. As soon as we start cutting that, they will probably cut in return. Okay, who are other countries that sell steel to us? Well, they are military allies. They are Netherlands, Germany, and France, UK to a limited extent, and Korea. All these are allies. You start cutting their steel, our imports of steel from them, you are going to have substantial alliance problems. And that has been conveyed to President Trump. The Chinese, as Jeff already said, only export under 1 million tons. You could eliminate that completely. It's not going to make any difference. Our total imports are about 30 million tons. So that's Lighthizer's problem. Well, he's an admitted expert in these kind of global trade restriction arrangements, so he might be able to solve it. If he can't solve it, the political problem that Trump faces is that all those constituents, and you can add in the coal people as well, who thought they were going to be delivered something, are quite disappointed come November.
Li Hong Wang from IBM. I'd like to draw attention to a fact and also echo Gary's last point about the power of market. So one of the criticism from the US and the EU about China's rapid improvement in technology is that the government concentrate resources on the technology R&D through all kind of state-driven programs like Made in China 2025 and action plans on AI and all this kind of projects and initiatives. But actually, if you look at the R&D expenditure funding sources, actually the share of the state funded R&D expenditures only account for like less than 1/3 compared with much higher share in the US. So this findings seems surprising for me because we expect that the Chinese government have more intervention in this all aspect of technology development than the US, but actually the fact is different. So I mean, it seems to me that the recent rapid development in the technology is more driven by the market instead of the government, meaning that it's just the market demand that caused this increase in the R&D input. So any actions to try to undercut the supply may not work at the US government wants.
Do you want me to?
I agree. I agree. I don't know what to add. Yeah, that's a very good question. Observation actually.
Well, what about protection of that property that results from the private investment.
Yeah, private investment in China, if it's in the so-called overcapacity industries, they do not receive government support as much as the state sector, so to speak. So in this regard, I think the Chinese policies favoring the state sector comes at a cost of the private sector. But actually, the private sector themselves are now sort of trying to avoid these overcapacity industries. They invest in IT, in telecom, in service-related industries, where the state sectors do not have a advantage. And they get financing. If they are large enough, they could still get financing from the state banks. But many of them, smaller ones, startups, they actually, China has a lot of money. It's just the money, whether the money is going to the right industry, to the right ownership of enterprises. That's the question. But in the service and IT sectors, I see a lot of money does go to the private sector. Right.
Next question.
This is Xinyan Finance. I have two questions here. The first one is regarding the Chinese real estate market for Dr. Gao. You just mentioned that this year the sales in the real estate market maybe start to normalize and maybe a little bit pick up in a later time. How do you forecast the Chinese real estate market in a longer time frame, like in 5 years, 10 years? Do you have any ideas on that? And the second question is for all the panelists about the trade war, whatever war between China and US. Can you think about any solutions for now, or we just wait for another wait for 3 years? Or if we don't have any solutions here, like how bad it could be? Thank you.
First of all, I think the trend growth rate of the sales volume of the real estate market for now is around 5%. And this level could be sustained for another 5 years or even a little bit longer, mainly because the urbanization ratio now is roughly around 60%, and there is still a quite big room for this ratio to go up, which basically supports the positive trend level. And possibly after 2025, the trend level may fall to zero level or even negative range. And by then, if at least in first-tier cities, if not some also major second-tier cities, if the price level, the price-to-rent ratio, and the stockpile or some other imbalance is still or even bigger, there might be some long-term major and very painful correction, but not immediately now, not before 2020, I suppose.
Well, I want to draw our workshop or conference, whatever we're calling this, to a close. I want to thank all of the audience for coming, the questions, but I particularly want to thank the CF40 people who have traveled. What? Second question. Oh, second question. Sorry.
Can I just make a very quick comment on the second question? My previous remarks seem to show that I quite supportive of trade and investment. But I also noticed during this trip that something has changed. I want to highlight the feedback from the U.S. business community. Back many years ago, when I was a student in the U.S., the U.S. review China's favored nation status every year. At that time, the U.S. business community was in strong support of granting China the most favored nation status. But this time, I heard the American Chamber of Commerce, and I also heard the European Chamber of Commerce seem to be not very happy about their members' experience in China. I think this is something China could review by itself. Why is that? Right? Is there enough respect for IP rights, or is there something else? But these things can be discussed, can be laid out on tables. Sanctions do not work. Sanctions probably will hurt both sides, especially if a country thinks their stock market is doing very well, and that's the big achievement. Things could change when severe sanctions are imposed. Thank you.
Okay, thank you. Again, I wanted to thank CF40 and you want to say something too, Jeff?
One last thing, because I've been so negative. I don't think any of us talk about trade wars. We talk about trade frictions and increasing trade frictions. And that's almost an inevitable consequence of having a more comprehensive economic relationship. The more trade and investment you have, the more opportunities for friction. And we used to have more disputes with Canada than with any other country. And that may become the case in the coming months as Canada resists some of the pressures on NAFTA. But in the U.S.-China context, I don't think in the near term there's good prospects for bilateral trade deals, but I think there is an opportunity that neither side is looking at very carefully, but should, to work together on a broader regional or multilateral platform. And I mentioned the plurilateral agreements or initiatives that could be launched in the WTO or independently of the WTO in e-commerce and in services. The U.S. blocked Chinese participation in services, and that was a bad idea. If the movement towards more reform and disciplines and services could lead to changes in domestic Chinese policies, as earlier iterations of WTO negotiations led to changes in Chinese domestic policy at the turn of the century, then it could have a good result. Same thing on e-commerce. We both have strong companies in that area that could benefit from clear and objective international rules, rights, and obligations. Those are two areas where we could be working together. And if we can get past the diatribe of some of the specific trade disputes, we might find that there's strong commercial and strategic interest in both of us working together on a broader regional or multilateral platform.
Anyone else want a last word? Again, thank everybody for coming. Thanks CF40 for bringing such an outstanding group of economists to interact so frankly and productively with us here today. We're closed. Thank you.